BP slashes payout to fund shift from fossil fuels. To view the full article, click the first link in the description below. BP says it plans to slash dividends as the global oil company prepares for declining sales of fossil fuels by boosting investment in alternative energy projects. London-based BP said it will increase spending on low-carbon technology, including renewable energy projects, tenfold to $5 billion $7 billion a year over the next decade. The company expects oil and gas production to drop by about 40% over the same period. To help finance this strategic shift, BP said it will cut dividends to $5.25 a share from $10.5 in the first quarter. That will help the company meet its previously announced goal of achieving net zero carbon emissions by 2050 or sooner. BP announced the shift as it reported a second quarter operating loss of $6.68 as the COVID-19 pandemic cuts oil prices and demand for energy. The figure, which excludes one-time items and changes in the value of inventories, compares to an operating profit of $2.81 in the same period last year. These headline results have been driven by another very challenging quarter, but also by the deliberate steps we have taken as we continue to reimagine energy and reinvent. BP Chief Executive Bernard Looney said. In particular, our reset of long-term price assumptions and the related impairment and exploration write-off charges had a major impact. The dividend cut comes at a time of tremendous change for BP. It had already embarked on a restructuring plan to ensure its long-term viability that includes 10,000 job cuts globally. Many thought BP should have made the cut 3 months ago at the same time as rival Royal Dutch Shell, which cut its dividend for the first time since World War II. In reality, it would have been extraordinarily difficult to justify paying such a high payout while cutting jobs and selling assets at the same time, said Michael Hewson, chief market analyst of CMC Markets. The pain in restructuring the business needs to be spread evenly, and it's to view the full article, click the first link in the description below.